China's weekend decision to adopt a policy of flexibility for its currency is no surprise for HSBC's chief China economist, Xu Hongbin, who joins us from Hong Kong for his take on the policy shift. Good morning, Hongbin. Good to have you with us on the show. Now, let's take a look. No widening of the trading ban, no one-time revaluation. Just how significant is the move of the weekend in rebalancing the global economy?
You know what, I'm surprised to see that the market take this as a surprise, because back to 3 months ago, PBOC Governor Zhou Xiaochuan made it perfectly clear that the de facto dollar peg is just a temporary arrangement for China to deal with the global crisis. And what we have been seeing since then is that China's economy has been recovering very strongly. Export has been rebounded much quicker than most people expected. Even the labor market show a significant improvement. People talking about labor shortage. So all this suggests that actually now is the right time for China to normalize its kind of exchange rate policy. In other words, to return to the early system of the managing floating. So it's nothing. It shouldn't be a surprise to see that actually China makes such an announcement at this time.
Hongbin, in your report, you talked about the PBOC adopting a basket of currencies in managing the RMB's fluctuations. Tell us more about that.
Yeah, when I say that, we're basically it's not surprised, because it's just basically China try to return to the earlier system of the managing float, in other words, before the crisis. But however, I think there is some kind of slight difference this time around versus the earlier system. Number one, I think that the PBOC has emphasis, seems to me, to signal the increasing role of the currency basket for them to determine the fluctuation of the exchange rate going forward. What that really means is that probably how the euro is going to move, it's likely to have a slightly bigger kind of influence in terms of how renminbi is going to move going forward. And secondly, I think that's basically, in other words, I think we're going to see the two-way volatility probably is likely to be bigger than pre-crisis. But however, I think given that the renminbi has already appreciated by 4.3% against the trade-weighted basket, which is even more than the average 3.4% annual appreciation before crisis, which seems to me that there's no strong reason for us to see a quick appreciation of renminbi against the dollar.
Isn't there a need for China to take more steps to increase domestic demand to boost the global economy? I mean, isn't that needed?
Of course, yes. China has been, keep saying that they want to boost the domestic demand. They want to shift the growth driver away from investment, export to private consumption, but there are many ways for them to do that. I think that the most important way is basically for them to, for the government to put more resources into the social welfare system, so that the people can lower their precautionary saving rate. That's the most important kind of the ways for China to boost the consumption. Sure, the exchange rate, I think, is useful, but it's not going to be the most important policy tool for them to achieve that.
Hongbin, the speculation that less intervention on the yuan will mean a cut in demand for U.S. treasuries, is that a fair assessment?
Well, I think yes, to a certain degree, yes, because once China is more focused on the currency basket, which means that we're going to see a greater volatility of the renminbi against the dollar. So from that point of view, I think that will probably disencourage the Chinese to put more kind of the increase in the foreign reserve into the dollar. I think basically we'll certainly see kind of the continuous diversification of the Chinese foreign reserve, but in terms of the stock of the Chinese foreign reserve, which already in the U.S. Treasury, I don't think that there's much they can do, at least in the near, in the near term.
Xu Hongbin, HSBC's chief China economist, thank you for being on the show today.